Joining us now is Stephen Biggar from Argus. Stephen, nothing's happened yet. It's, again, just kind of one of these things the president has said. Any way to analyze this from a stock perspective?
Well, hi, Brian. Sure. I think it doesn't come entirely out of left field, right? Candidate Trump had proposed this in his campaign last year, and there was actually some legislation proposed earlier this year by Senators Sanders and Hawley, just shortly after the inauguration. So it's not completely by surprise, but the issue for me is that when you mess with banks' ability to price risk and only adjust that one part of the equation, the interest rate, bad things tend to happen, right? Whether it's removal of the credit availability, which is very much a disservice to consumers, or you put extra risk in the system for not being able to cover the credit costs. In cases of home lending in the pre-financial crisis era, you make loans too easy to get and fuel speculation, bubbles, and then a collapse in the very asset you're trying to help. So, where you move lending to less regulated areas. So I think it's really important to be careful here. Guardrails are important, but overregulation can be just as detrimental as under or poor regulation.
Did the market then overreact today?
Well, no, I think there's still some headline risk, and the companies most affected, the Capital Ones, Synchrony's, and even Amex to some extent, do have the exposure. And I think until we get some clarity on the timing of this, and I think the industry is going to, of course, push back very hard on this and talk about that potential for less credit availability and their need to make a profit and so forth. I think banks have, and the pure play credit card companies have some things they can do, to get more efficient, to price risk a little bit better in the credit card market. It's almost a one size fits all. So if you have better credit quality, a better credit score, you get a lower interest rate and so forth. But look, the industry has and regulation has done a lot to try to educate consumers on this notion, right? They talked about how long it will take back to if you're paying only at the minimum amount, what the total financing costs would be. All this has been added to statements due to regulation, and consumers, it's a pretty inefficient form of lending, but consumers still go there.
I read something where if this were to happen, and again, huge if, I know that it could damage or kill or change all the perks, all the stuff that, the TV commercials try to sell us on, airport lounge access and all that stuff, that's paid for by lower income borrowers because it kind of goes into the pot. Is that a big risk to an American Express or a Capital One that I'm guessing make a large part of their customer base on some of the things, hotel points and whatever, they're able to offer back?
Well, rewards are incredibly important for consumers at this point, right? And we see that the consumers have shifted an awful lot of spending towards credit cards because of that, because of the safety, the convenience, and the rewards activity. So to the extent you discourage that, if banks are going to, again, pull in their credit availability, and the fact that these are costly to the credit card companies and the banks, they could pull back on those rewards programs. And that's another way that they could, sort of help on the expense side if something like this does get implemented.